Here's a question most mutual fund investors have never been asked. Which version of your funds do you own? Because every mutual fund in India comes in two versions. Same fund, same manager, same portfolio, holding the same stocks, run by the same people. One is called regular and the other one is called direct. And the regular one slowly costs more every single year. Checking which one you hold takes about 2 minutes. And I'll show you exactly how before this video ends. That's the practical part. But hiding inside it is a real puzzle. By most estimates, a large majority of individual mutual fund assets still sit in regular plans. Why? Hi, I'm Preeti. I run the Personal Finance Club, and in this Know Your Assets series, I take one asset at a time. Today, it's not a new asset. It's the two price tags on one you probably already own, the mutual fund. By the end, you will know which tag you've been paying and whether you should change it. Until 2013, this question didn't really exist because only one version was there. Every mutual fund came with a distributor's commission built into its price, whether anyone actually advised you or not. Then SEBI stepped in and required every fund house to offer a second version of every scheme stripped off that commission. The direct plan, cheaper by design, identical in every other way. More than a decade later, most of the money is still sitting in the odd, expensive version. Crores of investors, many of them sharp people who compare prices on everything from flights to vegetables, paying extra for the same product, year after year. If there's one sentence that explains it, it's this: regular plans are sold, direct plans have to be found. Banks, distributors, and many investment platforms earn money when you buy a regular plan and not a direct one. That's why nobody knocks on your door with the cheaper version. To see how that plays out in your own account, there are three things to look at. The first is the cost itself, because you've never actually seen it. When you invest through a regular plan, the distributor who sold it to you earns a commission, which is called a trail, often around 0.5% to 1% of your money, every year for as long as you stay invested. You never really write them a check. The money comes out of the fund's value itself, shaved off before the NAV you see is published. That's why most people never even notice it. A cost you never see doesn't feel like a cost at all. And notice what that trail is a percentage of. Not the advice you received, your money. If your distributor had met you once in 2019, they're still earning from every rupee you've invested since, including every SIP installment that went in on autopilot. The commission doesn't grow because your distributor does more work. It grows because your money is growing. Now the second is the size of it, because 0.5% sounds harmless. So let's compound it. Say you run an SIP of 20,000 a month for 20 years. The direct version of your fund earns 12%. The regular version of the same fund after a 0.7% trail earns 11.3%. At the end, the direct investor is sitting on about 2 crore. The regular investor about 1.8 crore. 18 to 20 lakh gone. Not to the market, not to a crash, but to a commission on a decision you made 20 years earlier. And here's the uncomfortable part. The longer and more disciplined you are, the more you pay, because the trail follows your growing corpus. It's a fee on your patience. Now the third one, and this one matters the most. Sometimes the expensive version earns its keep. A good distributor who does real work, handles the paperwork, gets you started years before you would have actually started yourself, and most valuably, talks you out of cashing everything at the bottom of a crash. Investors on average earn meaningfully less than their own funds, mostly by entering and exiting at wrong times. So a person who keeps you invested through one bad year could be worth more than 1%. One nuance here though, and it's not to put distributors down, just to name the incentive. A distributor earns from commissions. So what's best for you and what's best for them may not always be the same thing, which is why SEBI created a separate category altogether, which is registered investment advisors, who charge you a fee directly, earn nothing from the products that you buy, and are legally bound to put your interests first. A simple way to remember the split is this: distributors are for transactions, advisors are for advice. So if you know what you pay and you know what you get, regular can be a fair deal. Now, let's get to the practical part. The easiest way is to go to the MF Central website and download your consolidated account statement. You can also do this through CAMS or KFintech. It lists down every mutual fund you own across apps and platforms against your PAN. Then just read each scheme's name. If the word direct appears in it, you own the direct plan. And if it doesn't, you are in a regular one. And your investment is paying a trail commission on that money right now. That's the whole check. 2 minutes and you will know something about your money that most investors have never looked up. Now, before you do that, slow down for 3 reasons. 1. Switching means selling the regular plan and buying the direct one. And selling can trigger capital gains and sometimes an exit load. So it needs a little planning. Second is that if you go direct, the responsibility that comes bundled with your distributor comes home with you. Choosing funds, staying invested, not panicking. If you're not ready for that, cheap can turn expensive very fast. And 3, if your distributor gives you real ongoing service, you might reasonably decide to stay. Just make it a decision and not a default. A simple first step is to leave your existing investments alone for now and start your new SIPs in a direct plan while you work out the rest. So now, why is India's most money still in the expensive version of the same product? Here's my reading of it. It's not carelessness, it's design. The cost stayed invisible. The cheap version was not given by any salesman, and the default did the rest. You were never asked to write a check, which is exactly why you never stopped paying. The fix is not anger. It's the 2-minute check followed by one deliberate choice. Pay for advice knowingly, or don't pay at all. And one last thought. If 0.5% hidden inside a mutual fund can slowly cost you 20 lakh, it's worth asking what happens inside products where commissions run into double digits. Some traditional insurance products. We'll get there. Until then, if you want help reading your statement, that's exactly what we do inside the Personal Finance Club. The link is in the bio.